Hello, dear listener. Let's get ready to rumble. Hope you are well. Delighted to be bringing you this episode 328. We're flying. We are flying. The sun is shining here on the Mead Gold Coast, as I believe it is across the country. I was talking to Shun and Kerry and Aoife and Galway there a little while ago, and it's sun is shining on this fine country of ours. Speaking of fine country, I'm here to give you an update in terms of index investing versus active investing. Why low-cost index investing still has continued to outperform the majority of actively managed funds, some of the myths around index investing, and why they probably don't hold an awful lot of water, and how any of this applies to you if you are heading towards retirement ultimately, or if you're accumulating in a significant way. And I will note that not all low-cost index investing is the same. There are thousands of indices out there. Not all of them are great. You can compare lots of, let's say for argument's sake, a global equity index. You can stack up dozens of those side by side, and there will be massive performance tax variance ultimately between them. And so it's very, very important that even if you are going down the route of active or passive for that matter, that you pick the right vehicle or the right provider to do so. Please don't go blindly into it thinking, oh yeah, I click this button, it's passive, it must be good. That is not the case. Okay, so that's just a little bit of a health warning. I do obviously, and I know I'm biased here, I do always suggest that it makes sense to get actual help, qualified help in doing this stuff. So anyway, with that rant over, let's get on with the show. 2020 was the last time that I shared in real detail the SPIVA report, SPIVA, which outlined in 2020, so it's 5 years ago now, the uncomfortable truth that active fund managers find it hard to wrestle with and to match the performance of index funds on a like-for-like basis. Most of them consistently fail to perform in line with the market, never mind beat it. And an index delivers the performance of the market. It doesn't try to beat the market. It gives you the returns of the market, which for the vast majority of us is more than enough over the long term. So there is more research now from SPIVA and more data and results ultimately for 2025, bringing us up to 2025. And guess what? Nothing appears to have changed in terms of active managers underperforming passive index. So today I'm going to share why that is, share the latest details and data and results from US and the rest of the world. Why much spoken about market concentration isn't a reason to abandon passive investing, in my view, and common arguments against indexing and why they may not hold an awful lot of water. And how any of this applies to you, as I said, if you're approaching retirement or you're accumulating in a significant way and you're looking for a smart, potentially stress-free investment approach. Now, and this is the thing, like if you are accumulating for retirement if you're very near the point of retirement, or if you've recently exited employment, for argument's sake, you're now facing a different kind of pressure possibly. And that's how to make sure your hard-earned wealth and accumulations work for you over, hopefully, several decades of retirement. And so that's the reality. Unless you're going to buy an annuity, you're going to want these assets to perform for you over the long term. All right. Marginal gains will absolutely make a significant difference over the long term. And so you'll want to make sure that this is working for you. And ultimately, you're not alone. And the good news is that the data suggests and indeed makes a very strong case for a simpler, smarter approach. So let's dive off the top ropes and explore, shall we? And before I do, apologies for all the wrestling analogies. I took my two lads to WWE in Belfast the weekend. I never thought I would, but I did. It was such an over-the-top show that it's imprinted in my brain. People jumping off the top ropes and doing 619s and all sorts of stuff. What a show. What a show. I will say that. 3 hours of non-stop action, entertainment. The lads are mad keen to go and do it again. I've told them it's a once-off treat. So we'll see who wins that battle over the coming year or two. I believe they're coming to Dublin in August. We might be away for that one. But anyway, so there's a little bit of wrestling analogy here for a bit of crack. Please pardon that. So passive investing, still the champ? It certainly seems so. As I said, S&P Global Ratings, and I have a link in the blog. If you go to informeddecisions.ie and click on the blog, and you'll see this particular one there. I have links in there and indeed graphs to share with you. The S&P Global Ratings published their annual report, the SPIVA report, which compares ultimately the S&P 500 and global indices, cross equity, and bonds, fixed income as it's called, Europe, America, Australasia, small caps, etc. And it's for the full year 2024, it's the same again. Nothing has changed, more the same. In 2024, approximately 2/3 of active fund managers underperformed passive index funds in 2024 for the full year. And that's like, okay, so if I'm picking an active fund manager, the probability was that 1 out of 3 did better than an index, right, for the full year. But the reality is when you zoom out for the past 15 years, and this is where it gets really kind of scary, to be honest with you, for the last 15 years, 90% of active funds underperformed low-cost index funds and ETFs. And that's the reality. So in the US, for argument's sake, it's 89.5% of active funds underperformed the S&P 500. 10.5% outperformed the S&P 500 for the last 15 years. And before we body slam or pile drive this as yet more US-centric data and research that doesn't really help us or apply to us, we also can look at SPIVA's research on the rest of the world, which they publish, right? It's really, really interesting. Go to their, just Google it, SPIVA report for 2024, and you can click through. We soon see that it isn't just a US issue. It's the very same story across developed markets, emerging markets, bonds, and small caps. It's the same. In fact, the data suggests that the underperformance in international equity is consistently, the underperformance is higher at 75% in 2024 and 90% in the past 3 years and the past 5 years as well. Right? So it's a real issue. It's a real issue if you're trying to pick an active manager to pick one that will deliver or that has delivered and therefore will in the future, or to pick one in the future that will deliver. And that's a real issue. Okay? You might say that's grand, but like there are some that do, obviously. And yes, there are. So there'll be some active funds out there that you see and like, whoa, okay, that's pretty impressive, right? Because they've happened to pick and to rely on some combination of asset, whether that's companies or it's bonds or whatever the case may be, whatever the particular asset or fund type is. Yeah, so, but some do outperform the index, and that's important to acknowledge, right? They do. Over the long term, as we've seen, it's about 1 in 10 outperform the index. So if you're at the point now where you're an active investor or you're at a point of retirement and you're saying, right, I want to invest for my future. I don't, what happened in the past is kind of irrelevant. I'm looking at 2025 onwards, right? So I've 25 years, for argument's sake, for illustration, of a retirement ahead of me where I want to grow that wealth. I want to draw income in line with inflation, whether that's from an ARF or it's from the investment assets, or whether you're looking for dividends, or you want to draw income, or you want the flexibility, whatever the case may be. You want to protect and grow and accumulate and also draw income. Is active or passive better? Well, again, based on the data, we have about a 1 in 10 chance of picking a winner in terms of fund managers. And that's a scary proposition. We know that nine times out of 10, we will outperform, and we have outperformed by using an index approach. So if this is my life savings, my future income and the legacy that I leave to the next generation or to loved ones is dependent on, which one am I going to have confidence in ultimately? And that's the question. So that is what it boils down to in practical terms. And so for most of us, it's like, well, maybe I've been in active funds, and I've had some good gains. So look, I'm staying here. Okay, right. That's your choice. And the reality is that the probability of that working out appears very, very low. The probability is that we will fare much better in an index approach. And again, it has to be a decent index approach, not just any index, right? But that's the reality. That's what we have to consider. That's a challenge. And if you do want to go the active fund route for whatever reason, just because active manager A, let's call them the Undertaker, has beaten a global equity index, for argument's sake, if that's the approach that the Undertaker has taken, they've beaten a global index approach. Let's call the global index approach the Ultimate Warrior, right? For the past 5 years or the past 10 years. It doesn't mean that they will beat the Ultimate Warrior for the next 5 years or 25 years. In fact, it appears that the probability of the Undertaker continuing to beat the Ultimate Warrior into the future is even lower, given the rarity of consistency. You're relying on that one active fund manager continuing to have that run of success, or as some people, including Nobel laureate winner Daniel Kahneman, calls luck. And that's the reality. So if you're relying on active fund managers to deliver the outperformance in your retirement years or retirement decades, you might be betting on the wrong wrestler ultimately. Even if you are, or even if they are called the Undertaker and are beating the Ultimate Warrior at the moment. So that is something to consider. All right. That's the reality. That's what it boils down to. All right. So what are you talking about, active versus passive? Well, how can I access active? Well, you can, the Zero or Interactive Brokers or any of those online platforms where you can do it yourself. If it's non-pension assets, you can go and buy whatever you want out there. An awful lot of people do that totally blind as to the tax consequences or the treatment, or whether it's dividend paying or not. They haven't a clue what they're buying. It's just, it's passive. So it must be the right thing. Be careful is what I'm saying. Be careful. When it comes to pension assets, those routes are not available currently. So it's a case of, okay, will I do an insurance company? Do I use my occupational pension scheme? Do we have index funds? Yeah, possibly do have index funds in there from some of the providers, but usually they're layered with fees and underperformance. Or do I use an advised platform? Right, that's the type of route that we most often use for clients because it's cost effective, it is transparent, and we get the performance of the market. So you have different options depending on different scenarios that you're in. And that latter type is really only suitable when there's significant accumulated assets. So there are different routes out there for different people in different scenarios and different timings. Again, I do believe it's really important to get advice and make sure that what you are investing in, if you're going irrespective of which route you're going, is going to deliver what you expect and hope it to deliver. So the consistency is very rare from an active outperformance perspective. And that makes it very difficult to pick a winner going forward. You can't rely on past performance because the probability of the future performance and outperformance is so low. That's a challenge. So some of the things that people say about indexing is they're anti-indexing arguments ultimately, and why I believe that they don't stack up. And of course, not everyone agrees, and that's the reality of life. Not everybody's going to agree. Some, including those with an interest or a vested interest in the active manager space, will argue that that this time is different, or the current environment is a huge opportunity for the upside, etc., etc. Right? This is our time to shine because there's so much geopolitical risk out there. Baloney, to be honest with you. Generally absolute made up nonsense. It's just capitalizing on fear is what it is. But let's look at the two most common arguments as to why indexing is maybe not good as opposed to why now is different. Markets are too concentrated is one much talked about claim at the moment. In 2024, so last year, a small group of tech giants, the Magnificent Seven, as they were called, made up 1/3 of the S&P 500 and drove more than half the market's gains, according to an interesting article in Yahoo Finance that I've linked. But this sort of concentration isn't new. 200 years ago, it was bank stocks. 120 years ago, it was railways. The late 90s, it was the internet. The broader market delivered despite those things changing. Okay, those concentrations becoming diluted. The broader market delivered. If you were diversified, you've done extremely well in those periods. All right. And in fact, an amazing study that I came across from Morningstar found that from 1926 to 2023, almost 100 years, just 4% of all US companies in that time, of which there were 26,000 listed companies, have accounted for nearly all of the market's long-term outperformance. That is how it has always been. Outperformance is delivered by a small few. It's even bigger than the Pareto principle, the 80-20 principle. All right, it's colossally weighted towards the big performers. And the beauty of an index is that you always own them. You don't have to select them, or you don't miss out on owning them. If you're selecting active stuff, you own them all. And I know that's a US-centric piece of research, but ultimately we could apply that across the board. The only way to make sure you own those winners on an ongoing basis is to own the entire market, as opposed to trying to select and deselect winners and losers as active managers do. Instead of backing just one wrestler to win, you have an interest in them all ultimately. All right? You won't make a total killing. That's what active managers are trying to do. But you won't get killed either, which is key, dear listener. It is key. We do not get killed. We have never been killed by being a diversified, globally diversified equity investor. That's the reality. Second claim that people make is that indexing is distorting price discovery. Yeah, okay, right. Do you want to explain that a little bit? Well, this is the claim that the rise of passive investing makes the market less efficient and more bubble prone. This might sound reasonable maybe initially, but here's the reality. Even if 99% of investors were passive, the 1% active traders would still be enough to keep prices different, because there is that flux amongst the 1%. And during and after the internet bubble, which was arguably the bubble of our time, most active managers still underperformed the index, even when mispricing and huge variances were rife. So yes, bubbles happen. And I found an article in my research for this piece. I found an article from 2010. All right. Um, the title of which was How Index Funds Distort Markets. I said this was from 2010. Okay. So it's 15 years ago, which stated that index investing, and index investors were distorting the market back then, and that investors would be better off over the coming years and decades allocating to active fund managers. The Spiva report has proven and shown that looking back those 15 years, that was total and utter nonsense. 90% of all cases since that article was written and published. Beating index strategies consistently as an active manager, ultimately that's still a myth for the vast majority. So what does all this mean for your retirement strategy ultimately? And that's the question that most of us would ask, all right? If we're looking to generate income for the next 25 years, 20 years, 15 years, whatever the case may be, this is a big question. Or if you're planning to leave retirement in the next few years and you're accumulating and trying to mind your pot, or if you've already left, the research suggests that we want to make sure that our investments are cost efficient, predictable, low maintenance, diversified, and resilient performers. Passive, globally diversified index funds, as a core of most portfolios, have checked all of those boxes for the vast majority of long-term investors, pension, ARF holders, etc. They don't try to outsmart the market. They own the market. They are the market ultimately. And over the long term, that's exactly what has delivered the best results for the vast majority of real people like you and I. They're also, dare I say it, boring, right? When it comes to retirement income over the next 3 decades, boring would be just brilliant. Thank you very much. It's the ultimate warrior of strategies, or the giant haystacks, if you're looking for a more local equivalent. So final thoughts. Ultimately, as we said back in 2020, or as I said back in 2020, I'll say it again today, most actively managed funds have failed to achieve the returns of the market in the past, and ultimately will likely fail to do so in the future. There is no reason to suggest that that is going to be different. It's not an opinion, it's evidence. Indexing gives you broad exposure, own the winners and the losers. We ultimately minimum stress, higher likelihood of success. That's what we want ultimately. We want good outcomes, not smoke and mirrors and talk or promises. The best strategy, in my view, is one that doesn't require you jumping into the ring every 5 minutes to get battered around the place. For most, it's one that lets you get on with life, get on with enjoying the next phase of life or retirement without second guessing every market wobble. That's the beauty spot. That is the beauty spot. So if you're planning your retirement, you're really looking at that, or if you've accumulated 7 figures of retirement assets and you're trying to make sure if your investment strategy is aligned with what your goals and what you should be doing, we're here to help. Please get in touch. Otherwise, I hope this has helped, and I hope it'll help you going forward, and I hope you enjoyed it. So as always, thank you very much indeed for watching and listening. You're a legend.